The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, as we take a look at the market trade action after Wednesday's closes, row crops held up with fairly two-sided trade, a little bit of pressure in wheat. Is this a case of us trying to go down and find some demand after a few days higher? Livestock trade, a solid rebound after a pretty rough start to the week in cattle. Crude oil down over 5%, though. We have plenty to take a look at and discuss here on the show. A lot of outside market concerns with the dollar and more. Here to try and make sense of all of this, we welcome in Mike Zuzolo with Global Commodity Analytics. Mike, great to talk with you again this week. I hope things are going well there in Kansas.
Doing great, Jesse. Thank you. We finally got the cold front through, and we're past about 2.5 weeks of higher 80s to mid 90 weather. So we're all breathing seriously sighs of relief at this point.
Yeah, I was going to say, I spent the weekend in north central Iowa back home with my mom and family, and went up there expecting that I was going to see some cooler temperatures, not even looking at the forecast, and then realizing that it's 90s. I mean, it's one thing, good, clean harvest weather, which is, right. I think, part of what we're seeing in the grains right now is that harvest pressure, but now it feels a little more like fall. I think that's a good thing for a lot of folks, Mike.
I would not want to be the guy cleaning all the filters on the combines at the end of the night. That's for sure. Not in this kind of weather.
No, definitely not. Definitely not. Well, let's try to make sense of the grain and oil seeds first here. And I mentioned some of that harvest pressure, but I think so too. We want to try and connect the dots here today. You know, what's going on with treasuries and the dollar and the stock market versus some of the other things going on in the grains. So let's just start. What are you seeing here? And now I'll pull up a few charts on the video feed for us to take a look at as well that you shared with me today. What's all going on? Connect the dots for us, Mike.
Yeah, let's start with Wednesday's trade because it's a great way to begin what we're going to try and do here during today's segment. And the key, I think, was the demand darlings of 2023 are starting to look tired. That's the feeder cattle, the soybeans, and the equities markets. And you notice Wednesday, they were the three that really wanted to try and bounce back and see some short covering. And they did. All three of them saw some pretty decent short covering throughout the session. Percentage-wise, nice short covering, as you say, given that the crude oil was on its way straight down essentially all session long, racking up over 5% losses by the time we started recording this. And I think those demand darlings, which I will say maybe are of the past, are now finally catching up and getting caught up in kind of the vortex of those macro fundamentals that wheat and corn have been caught up in all year long. Why? Because that demand is starting to waver and kind of maybe wave off the idea that consumption is going to stay red hot in soybeans, in equities, and in feeders. And it really goes back to the bonds. It really goes back to the yields in treasuries. This is a 2-year treasury, a lot of short-term money tied up in agriculture, a lot of notes 2 and 5 years, and they're hitting and already have hit levels not seen since 2006, 2007. And we probably talked about that last week. Well, this week, it was the 30-year treasuries that took off, and the U.S. 30-year treasuries also got up to levels not seen since 2006. And so you're draining the pool of money even more of potential investment. Why go after it when the stock market's cracking and when the bond yields are at 15-plus year highs? Go after the safe money is what investors are suggesting. And I think that makes sense, especially in countries like Great Britain, the UK. Their longer-term treasuries just hit the highest level in yield since 1998 today. And so this is just simply vacuuming out potential money investment flows, and it comes smack dab in the middle back into the grain complex.
We'll tie that in with the Bloomberg commodity index on the grain side, as I think this is a very interesting correlation for us to make. And I got a couple charts from you here on this, but walk us through and try to tie this together a little more for us, Mike.
Yeah, and I appreciate you going through this with me, Jesse, because really the things that we just talked about a few minutes ago, it may mean nothing to you, but this chart by itself should speak volumes. It's a correlation chart. It's a 3-month correlation between the 2-year treasuries and those yields in the treasuries against that Bloomberg grain index, the commodity index that we always look at almost every week on your show. And you notice the negative 0.94. That means on a 3-month running basis, those two assets have almost a 95% negative relationship in their prices with one another. And what more do you need to say when it comes to if the 2-year yields go higher, the Bloomberg grain index is probably going to be shut down in terms of any new buying. And I do think that's what happened in part on Wednesday's close. We saw the feeder cattle start to leak, followed by the soybeans. When we went on air, the Dow Jones futures were negative and the S&P was steady. Wouldn't doubt if they would close negative as well. And I think it goes right back to this.
Well, and looking at the actual Bloomberg Grain Commodity Index monthly chart, I think this helps illustrate it as well. You got some different formations that have been forming there, and I think this is just another. It's a little bit. You got to look a little more, I think, on this chart compared to the one you just showed, and say that 95% negative relationship. That's pretty point and cut and dry. But this too, I think, kind of illustrates some of the same points here, Mike.
Yeah, and this, you bring up a huge point. There's a lot in this chart, and if you want to talk individually about it, just sign up for a trial at the website and just go ahead and get in contact with me and say, look, I listened to Jesse on Market Talk, and I want to know more about this chart and what you're talking about. But there's a couple things here. Number one, the wedge. We always talk about that red wedge, that triangle. We went to the point. We tried to go higher. We failed, and now we're going lower. We've gone from about 46, 47 on that index down to this major support line of 40. That 40 line is really critical because if you notice what that chart looks like from 2000 all the way to 2023, that 40 level has been rock solid support for the whole Bloomberg grain index for 23 years, except for that time period when we went lower, which I designated with those red arrows going down. And you see a very well-defined 5-year cycle from low to low, 5 to 6 year cycle from low to low in yellow. And we continue to wonder whether 2024 may not give us that demand low because the cycles are suggesting that. And we've been able to stay above 40. And I think this is a critical time. And it makes perfect sense fundamentally because we've got the Federal Reserve that's still hawkish, trying to drive down this grain index by default because those yields going higher as they raise rates. And then you have the other big 800-pound gorilla in the room, and that's China. I've been surprised that President Xi has not been more pragmatic and moved more aggressively to get his economy kickstarted and regenerate their economic growth and their consumption more than he has. And it's making me nervous that he's more of a hardline autocrat and feels like he's kind of impervious to external influences at this point. And he's got his own agenda. He's got his own game plan. So if I had to guess, and this goes to that green number 6 and that 2024 demand low, that cycle low potential, if I had to guess, I think the Fed is going to have to blink here for us to get that demand low. But I do think it's getting closer to them blinking. Why? Because those same massive yields are now hitting everybody's 401ks through the stock market. And I think they're going to have to reevaluate what they're trying to do in terms of killing inflation, but what else are you killing too?
Well, to your point as well about China, China bought SRW wheat on Tuesday. I feel like, though, seems like that might have been just an aberration. And to your point, China has their own agenda here, Mike.
It's absolutely true. And you don't know why. I mean, it doesn't make sense that they would. It could be a quality issue. But I think it's probably more the issue of what happened in the northern parts, the northeastern parts of their country in the early spring, mid-spring time period with those heavy rains after having a pretty significant drought. But that's a yet to be determined type scenario. But you're absolutely right. The market was very surprised by that, but they couldn't shake even that negativity in the macro markets with such a big piece of headline news. And that just kind of shored me up when I wrote to clients over the weekend. We've got to have the Fed or China get off our backs here if we really want a major trend low. Otherwise, we can have rallies on China purchasing. We can have rallies on Australia's weather and their wheat crop going down again, in most likelihood, in my opinion, or Argentina's crop, or South American soybeans and corn. We could have weather rallies this winter, but they're rallies to sell because we haven't gotten that demand back yet. And I think that's really crucial at this stage, especially with that 40 number on that Bloomberg grain index. We're really on some massive support here historically.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics. Mike, you mentioned earlier one of the darlings of the year is the soy complex. I want to talk about soybeans a little bit more. I'm going to pull up another chart on the video feed for us to look at soy basis there in Memphis, Tennessee. We know there's river concerns with the levels on the Mississippi. I'm hearing a little more chatter as well. I'll kind of add into my question here. Farmers are maybe not selling as much off the combine as we initially thought they may. So I'm wondering if that is having some impact here as well, Mike.
Yeah, that really concerns me because the bottom line here for me at this stage of the game, I've got to sell either corn or beans if the yields are there. There's no way around it, even if you can store everything. But why am I saying that? Well, because the Mississippi River has not been recharged. And look, bottom lining it out, it's going to be hard, if not impossible, for us to get it put back up to a normal tow and a normal barge movement level at this stage of the game for the rest of the 2023 harvest. I talked to a client, to your point, in central Illinois, and he said, I'm into my beans pretty hard. I've got several thousand bushels that I would like to either store until Jan for basis improvement, or should I just dump them here? And, I said, the issue really becomes, and he was hitting 70s in his whole field, 60s, mid 60s, mid 70s. And I said, look, you take a 65 average against a 1240 price near Utica, Illinois, and you're talking about $800 of revenue, gross revenue per acre. How can you turn that down when we may see the bean yield, instead of going down, actually go back up in USDA's future October, November, maybe January reports? I just don't want to take that chance at this point. I still think that this chart right here really kind of seals the deal for me. Memphis, Tennessee spot soybean basis has gone from 90 under back on the 25th of September and has doubled that. It's now negative 180 a bushel for spot beans. It lost 60 cents just yet between October 2nd and October 3rd. It's not going to get any better. And we're still $50 higher than Brazil's Paranagua price at the Gulf of Mexico, Jesse.
Well, and to that point as well, yeah, I mean, you look at corn maybe getting a little more competitive with South America, but to your point, beans not so much. So you throw together the pressure from South America, the pressure from a low water situation on the river. I just can't imagine that basis is gonna look very good here by, say, mid-November, early December, Mike.
Right, and recall what last week's reports said and told us, as you brought up in the beginning of the program. We're at a 10-year low as of September 1 in corn stocks. We're at $450 in cash prices. But what do you sell? $450 corn on decent yields, or $1250 beans on better than expected yields? And I don't think we have to get it too complex at this point. We can simplify it down to that, and we can always come back around in January, February, if there's really a weather market out there, to come back in and buy some beans back if we need to. But I would say this, Jesse, if last week and this week has shown us anything, it's that continued market where the beans can go up a while, but it needs the wheat and corn. It seems to me it needs them more and more and more. And in fact, it's starting to go down now to kind of play catch up with how much losses the feed grains have had versus the beans. And so beans and wheat and corn were number 2 and number 3 biggest losers year to date in the 22 assets I keep track of as of last week's close, which was the end of the third quarter.
Mike, let's go over to livestock trade. I really want to get your thoughts in cattle here. Just a rough start to the week in cattle. We maybe found some support, or at least took a pause here. What's going on in the cattle trade? But I mean, man, oh man, big drop that makes me think that potentially the top is in. I'm just curious what your thought is with fats and feeders, and we'll look at a monthly live cattle chart here first.
Yeah, it's still a battle between funds and fundamentals. We still have a cash trade and say feeders, which has been the leader to the downside at this stage of the game, which makes sense because guess what was the number one asset of the 22 I keep track of year to date gain? It was feeder cattle up 36% year to date. And so this feeder corn ratio we talked about, long feeders, short fats, long feeders, short corn, I think the funds are starting to unwind that because the demand side of the equation and the feed costs are rebalancing. So my take on the fat cattle chart here is it's a pretty simple, don't overcomplicate it. You've got a major support line in place after having gone up 16 straight months in live cattle. If the feeders break lower and they go through 245, you're eating into some major chart support. And recall back in 2014, and you can see that on this chart, the 2014 high and this is live cattle, but in feeder cattle, the 2014 high in feeder cattle went from about 245 down to a 193 low in February of 2015. The feeders led the fats lower, and I'm nervous because of the funds that the feeders will lead the fats lower again. So I'm not willing to say a high is in, but what I am willing to say is you're essentially hedging $8 corn here, whether you're looking at feeders or looking at fats, especially before this market started to break.
Well, and I know I heard some chatter, a lot of folks in sale barns calling other folks and asking themselves this week, what's going on with futures, because we're still seeing high prices out here in sale barn country and in feedlot country. So I think that's an interesting thing, but I think we've touched on this before, usually one or the other tends to go first. It's either the board or cash. And in this case, it seems like the board's going first.
Yeah, and that chart also shows a major cycle. And past performance is not indicative of future results, but the production cycle and the price cycle are real in cattle. And you see that low designated by the bull in 2013, in the middle of 2013. We had a major low in 2016 because of some of the outside market fundamentals and also some of the pressures in the markets from other animals. But the major low, from 2013 to 2020, that's a pretty normal low, that 7 to 10 year cycle. And so if you're talking about low to low, then you're talking about 3.5 years to 4 years up, 3.5 years to 4 years down, plus or minus. And so my mindset is that all things being equal, it's time to really have to feed the bull in prices. And if you see the corn price go above 490 in lead month corn futures, and keep in mind, Mexico bought corn again today. They've got what they're calling a super peso right now because it's so strong, and they've got one of the worst droughts in about 20 years at this point, Jesse. So they're buying corn really aggressively now the last couple of weeks. What if they start buying enough corn to offset our weaker export market in other places? What does that do to the feedlot people and the people in the middle part of the plains who are still experiencing drought and seeing hay prices go higher and higher? These are the pieces of the puzzle I think we really got to think about.
I wonder as well. I mean, we know retail demand. We talk about that. We monitor that. Are we getting to a point as well that some folks, they might want a steak, but they're just saying, I just can't afford it, and they're going to pork or chicken or something else, Mike?
I think that's the case. ADP private payrolls, I was really eager to see what they came out today with, because I'd heard anecdotally with some colleagues in the jobs market, the jobs placement markets, that they were starting to really tighten up, that they were really not seeing much for new hires in their line of work. Well, ADP came out with the lowest private payroll data in 2.5 years. And so I think you got to look at that, and you got to look at the idea that this dollar keeps going higher. It's just going to bring more imports in, and as you say, cut our exports back. So this is the time of the year where it's really hard to generate a lot of beef consumption, especially during National Pork Month.
Well, Mike, final thoughts for us here on the program today. We covered a lot. You and I joked a little bit before we went on the air. I think, what was it, perpetual decline of commodities or something like that.
Perpetual digression of commodities.
Yes, that's it. And I say that in just a little bit. There's a lot going on here, a lot to dissect. What would you say to folks listening in and just thinking about their marketing plan and their strategy right now, what would you tell them for advice?
Just keep it simple here with all these factors. Lock in profit. Start with your cattle and your feeders. I mean, literally, the Kansas State numbers are north of $200, $300 a head right now for marketings in the fourth quarter. Stay current. Get some hedges in the form of puts, generally speaking, in both beans and cattle and feeders, and then sit back and see what happens in terms of a recession. But start with your profitable commodities. Don't get tied up in all this news and not do anything.
And Mike, I know if folks have questions, they can reach out to you there, Global Commodity Analytics, very easily, get a look at your analysis and much more, can't they?
Yes, that's right. Go to globalcomresearch.com. It's globalcom with two M's. I'll send you that last weekend update where I look at the quarter to date and year to date prices and kind of work through the idea of what's going to turn this market around.
Fantastic. Mike Zuzolo, Global Commodity Analytics. Always appreciate the time. Thanks for joining us today on Market Talk.
You too, Jesse. Thanks for having me.
That's going to do it for the program. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.